Well, starting your own business usually entails you having made the decision to start your own business in the first place. And sometimes that's an introspective sort of endeavor to begin with yourself. It's a personal sort of choice depending on your situation and opportunities, of course. And some people are ready to do that right out of the gun when they graduate and have an idea about their entrepreneurial drive. Others go at different paces and maybe more opportunistic and try to take advantage of what's presented in front of them. And once they gain an understanding of what might be involved, sometimes that gives you enough of that encouragement and confidence to venture out on your own. I mean, unless you're giving up a job that you probably can't go back to, the opportunity is really a little bit of time and perhaps even limited capital investment, depending the extent of your business endeavor. You're going to be renting some space from someone else. You can actually rent an entire office and with multiple rooms. The scale of it and hiring people, it's really something that you can control before you dive right in, either all the way or just want to dip your toes in the water. Because a lot of people in the health field to begin with are probably working in some sort of capacity that they are their own boss and kind of control their own schedules and control their own client appointments and those sorts of things. So there are certain aspects that kind of lend itself to somebody understanding what, or a large degree of what might be involved of running their own sort of practice or owning their own business. So, but once you've decided to do that, your first stop should be to visit your accountant and lawyer in order to understand what you should be doing in order to structure your affairs in a way that can benefit you the most in terms of protecting yourself from liability, just understanding your business risks, whether you're going to be hiring employees, renting space, getting on the hook for leases and other sort of contractual obligations. And that's where your lawyer and accountant can complement each other in terms of advising you so that you can start off properly. And some people maybe can't afford an accountant or a lawyer at the beginning, but we get it. We deal with startups all the time and people who are bright-eyed and eager to go. So we do have systems in place and sort of scaled back services to accommodate those needs and help deliver what exactly is needed on a minimum basis and beyond that too, depending on what your budget is. So, I mean, if you're going to do it right, sometimes that cost barrier isn't the main thing that's going to hold you back from getting good advice. You're paying for something because it's got to be worth it to you. And you understand that probably before you pick up the phone and call someone and start the conversation. So if you're going to venture it on your own, great, all the power to you. Usually when you run into a wall or a problem, that's when you're going to start making the phone calls later on. Problem is you won't realize you had an issue until it's too late or because it's a problem. So doing that up front is always wise, and it's probably the best advice I can provide for any startup, just to make sure that you're crossing the T's and dotting the I's properly. And that rolls itself into just trying to decide what type of entity you're going to have. Does it make sense to be a self-employed individual? Does it make sense to set up a corporation at the beginning? And if I set up a corporation or just have my own proprietorship, do I do that with others? And that might be a function of the opportunity in front of you, whether that's a formal legal partnership or some other informal arrangement. How much are we talking about here? What are we looking at? I mean, all the variables come into play. Everybody's personal situation is different. Geographical location sometimes can play into that. Are you working out of your house? Are you working out of a commercial place of business? There's so many factors. So it's hard to kind of give one kind of nutshell rule of thumb that would provide, enough advice. But, you got to talk about it. And that's what we're here for. So once you've decided to do that, you come meet with us. We'll tell you about type of structure you can have, and then we can talk about the ownership of that. If you're going to set up a corporation, so that can involve other family members, a family trust, and the level of complexity can go through the roof, depending what you want and how much you want to pay. But usually at the beginning, keeping it simple is the easiest, just to kick off and get going and focus on that business. So picking a name for your business is more of a legal function. I'm an accountant, but I've seen enough of that process as a third-party bystander to understand that your business name needs to be registered, or at least be available to be registered, so that nobody else is using it. And you want to protect what you have in terms of what you're operating under, because that name could be something of value later on, especially if you're starting up now and you say you have nothing. Well, it should be simple, and that could be easy enough to do. But the second you want to register, you're going to have to visit a lawyer, and that has to be done legally with the local government authorities. Yeah, speaking as a non-lawyer, when we're looking at the type of entity to use as the vehicle to run your business and operate your business, again, it's a bit of a personal choice. There's cost involved. There's a minimum administrative burden with running a business, irrespective of whether or not that's through a corporation, which seems to be the most common option that people gravitate towards, and rightfully so, because there's a lot of liability protection that could be afforded to you from operating a business through a corporation, rather than as your individual proprietor self in a self-employed type of situation. So those are usually the two types of call it structures that startups in the health field will consider to run their business. And again, depending on how much you want to spend and how much liability you want to protect, and kind of how much money you think you're going to be making in the first few years, and the tax planning that might come along with that, because you want to limit the extent of your exposure to tax so that you can retain enough wealth so that you can continue to grow your practice and your business. Well, sometimes that can influence your decisions. So, understanding what you're getting into and having an idea of what your plan is, and even a budget, and we can help you with, sorting those types of things out at the beginning, that could help kind of sway your decision, or at least inform you as to what might be best for you at the beginning, or maybe in a year or two down the road. So planning ahead for tax purposes is something that we do on a continual basis. So, I mean, it's hard. I don't have a crystal ball. No one has a crystal ball. Yep. But sometimes you do have some information available to you with respect to your business that can give you some predictability, or a certain level of confidence as to what your revenues and your expenses are going to be for the next year, 2, 3. And with that in mind, that will influence kind of your decision making with respect to how much money you're going to be needing for expanding the business, and the budgeting that comes along with that. Now, if we're dealing with a corporation, the tax planning aspect is multi-layered, because you have taxes inside the corporation, you have taxes at the individual level, whereas somebody who's self-employed will just have taxes directly from their business, because they are the business as a proprietor. So there's not too much in terms of tax planning that gets affected by your cash flows when you're a proprietor, because you just taxed on the business income. But when we're dealing with a corporation, sometimes the decision making can be influenced by what your business plan is and what your personal needs are for cash. If you need the money, quite often the answer is simply you take it out and you use it because you need to live. You need to pay for personal expenses. So if that is your only source of income in order to finance your living, well, then you need to take that money, and the tax result is going to have to be limited and managed to the extent that's possible, because you need to have that money in your hands at a certain point in time. But nevertheless, the strategy is always looking to either defer or reduce taxes, and that is done over time and in a way to minimize your exposure at any point, depending on where your year end falls when we're talking about a corporation. So paying yourself as a business owner, and I'll go back to the examples we seem to always go back to, is either as a proprietor or through a corporation, depending on how you're running your business. As a proprietor, well, there's no way to pay yourself. You are the business. So all the money you make through your business, net of your expenses, is your income. So you are paid. You're going to maintain a separate bank account, of course, for your business to track your business affairs separately. Nevertheless, the net profit is yours. So you don't actually pay yourself. You will just include that income on your personal tax return. The money is yours. In a corporation, again, it's a multi-layered type of exercise where you have the corporation as a separate legal entity with its own bank account, revenues and expenses, and income taxes. So when you need to decide how you're going to pay yourself, you can do that traditionally in a couple of ways. You do that through either a salary, where you issue yourself a T4 because you are employed by your own corporation as an employee individual, and you'd include that T4 on your personal income tax return. Or as a shareholder of the corporation, you could pay yourself a dividend. Now, a dividend is paid through the after-tax profits inside the corporation, so that the individual who pays tax on that dividend now pays a tax that's lower than someone who's receiving a salary. And what I mean by that is the corporation pays tax on an initial profit, and then it has profits after tax. Those after-tax profits inside the corp are distributed out to the shareholder, who then pays tax, but at a reduced rate. So those two layers of tax inside the corporation at the individual rate, using the integration theory that's built into our income tax rules in Canada, those two layers of tax should equal the tax that an individual would pay had they just earned that income directly as a salary in the first place. So there's no, call it, tax advantage to the combined rates through a corporation and a dividend versus a salary. The idea is you can sometimes benefit from the timing of those payments, whether we're dealing with the corporation's year end versus the calendar year, which an individual pays tax on based on a calendar year. So you can sometimes get the benefit of a deferral or kicking your tax bill down the line versus somebody who's just getting a salary. So there could be some advantages there. As well as there's no CPP on a dividend. So there could be a little bit of an advantage there. But then again, you're foregoing your CPP that when you one day retire might not otherwise have access to. You're giving up things like RSP room contribution as well by taking a dividend. So again, pros and cons to both, depending on your needs and what you can afford and what's available in terms of opportunity. And again, I want to highlight what I mentioned, that the tax rate integration theory is baked into our tax policies in the Income Tax Act. But again, it's a bit of a theory because everything assumes that you are in the top personal rate as an individual when we're talking about this integration and all the tax rates work harmoniously. But in practice, they don't. And quite often that is as a result of provincial legislation and other factors as well. So if there's anything to be gained by either staying below the top rates as an individual, if you can, or perhaps even income splitting with family members where it does make sense, and that's possible without offending, a lot of the bad rules that, counter that type of planning. We would look to take advantage of that so that you spread the tax burden across the family and hopefully lower the overall impact on the taxes that you're exposed to as a family, so that you retain as much wealth as possible for your business and your family. Yeah, that's the next question kind of in the process. After you set up your corporation, you got your structure in place. What tax rate applies if I have a corporation? Now, we already talked about having an individual who earns business income as self-employed. They're just going to be taxed on their income at their personal rate because they're a self-employed individual. So keeping that aside, if you have a corporation to conduct your business, the corporation will pay tax, and then it will retain that after-tax cash profits inside of that corporation. At that point, again, it's the corporation's money. It's not the individual owner's money until the individual owner takes it out. And as we've said, the individual owner can take it out in two ways, either as a salary or as a dividend. Now, if you've already paid tax on the money inside the corporation, you can't take it out as a salary anymore. You're left with taking it out as a dividend because it's been taxed already one layer inside the corporation. So when a corporation takes its after-tax profits and distributes it as a dividend to the owner will pay tax on that dividend. Now, going back to our integration theory, those two layers of tax should be equal to the tax that an individual would pay had they just earned the source income themselves directly in the first place. So whether you earn business income or salary versus directly as an individual versus through a corporation paying corporate tax, paying a dividend out, and then have an individual paying tax on the dividend, that combined tax should be the same. And that's the idea of integration in Canada. Again, it's a theory because certain policies at the provincial level and other factors skew the results, but generally speaking, the taxes do approximate to be the same. However, it makes a significant assumption in that the individual is already at the top bracket personally. So somebody who's earning business income as an individual, it assumes they're at the top rate in their particular jurisdiction. So in Ontario, that would assume that the individual is paying tax at the top rate of 53.5% in 2021. So if we were to compare an example of an individual earning, let's say $100 of income, they would be paying tax at 53.5%, which means they'd be left with about 46 some odd dollars personally after tax on that $100. If we were to compare that to a corporate scenario where a corporation now earns $100, the corporation, assuming they're eligible for the small business deduction, would pay tax at about 12%, 12.2 in fact, in 2021. And that means on the $100, they would be left with after tax about $88. So with that $88 now after tax in the corporation, and you can see right off the bat, the corporation would have more money to reinvest and expand the business if it does not distribute it out to the shareholder individual. But assuming that we are going to distribute it out, just to continue with our example, that $88 now gets paid out to the individual shareholder as a dividend. Now, again, you're not paying out $100, you're paying out $88 because the corporation's already paid about $12 of tax. So now the $88 goes to the individual shareholder as a dividend. That dividend gets taxed, again, assuming the top rate for that individual because they have other income, which puts them into the top bracket. And on that dividend, the individual would pay tax at just under 48%. So at about 48% on that $88 dividend, that means the individual would pay personal taxes of about $42. So the 88 minus the 42 would leave them with approximately $45 to $46 after tax, which is pretty darn close to the about $46 that we said the individual who just earned it directly and paid 53.5% on their $100 would have. So that's the idea behind integration and the theory that should apply, again, assuming the individual receiving the income is in the top bracket to begin with. Of course, not everybody is in the top bracket. And if you are managing your own affairs with your own corporation and your own business, you can manage whether or not you are going to achieve the personal top bracket, assuming you have no other income and your only source is that business. We would work together to try to manage the beneficial use of the marginal tax rates afforded to you leading up to that top rate of 53.5%. So that, yeah, I mean, integration could work to your favor if you had a corporation and you're only paying yourself less than the top rate, which is about 53.5% once you hit $220,000. So it's not on everything up to 220. So once you're at $220,000, you start to pay 53.5%. Prior to that, your tax rates are lower, and that's why we have the marginal progressive tax rates. As your income goes up, your tax rates go up too. So we would look to manage your remuneration. And again, if you have a corporation, you have more flexibility because then you can decide whether it could be partly salary, all salary, or a mix between salary and dividends, or just all dividends, so that you can manage your tax affairs to again, minimize your exposure to tax and therefore maximize your after-tax cash once you've had to pay your personal taxes on extracting the money from your corporation, and for you and your family. So when we're dealing with remittances, we're talking about remittances to the government with respect to your pay, um, and you'd be paying yourself, not as a proprietor, because again, we've mentioned that as a proprietor, you just earn the income directly. There are no remittances there. You're not paying yourself a salary. But if you had a corporation, it's your corporation that would be paying you a salary. And if you decide to pay yourself a salary, that salary would be subject to normal withholdings that any employee would be subject to in connection with their employer. So the employer in this case would be the corporation, and there would be withholdings like income taxes and CPP and potentially EI if that applied. There's certain benefits you may want to look at tapping into if it makes sense for your particular situation and opt into EI programs. But nevertheless, CPP and income tax would need to be withheld on salaries paid to owners of a corporation and remitted to the government on a periodic basis. Now, as an owner, you get to kind of choose how often and when you pay yourself. So again, that gives you a lot more flexibility as to when you have to remit to the government with respect to your salary and when that gets drawn out. And we have ways to manage that and minimize kind of the cash that needs to exit your corporation and be given to the government. As an individual proprietor, again, no remittances to the government, but you're probably going to be subject to installments on your income taxes anyway. And that's a function of how much money you've earned in the last couple of years or expecting to earn if you're going to be remitting on that basis. So there'll be at least 2 remittances in the year, perhaps more, depending on your cash flow needs. We would look to manage that as well. Keep in mind, corporations also have to pay income tax installments. So income tax installments on their income. So that too is a bit of a drain on the cash flows. And the reason why you make income tax installments, whether you're an individual or a corporation, is because the government doesn't want to wait for their money. They want it in advance, and they want to make sure that when it comes to the year end for the corporation or the year end for the individual filing their tax return, there isn't a huge bill that has to be paid, and the governments have received, something in advance so that there is a credit that you can draw on when you finally file and prepare your ultimate tax return. And if that results in a refund of taxes, well, that's fine. The government's happy to issue you the refund without very much interest, might I add. But if you end up owing the government because you didn't make those income tax installments, well, that could be very punitive, because when the tables are turned and you owe the government, well, that's when the interest rates are much higher and things like penalties can be imposed, which can really undo a lot of the savings that may have otherwise been had just by retaining the cash and not having made the installments in the first place. So it's usually wise to make some sort of installment payments, especially when you expect to be taxable at the end of the year, whether you're an individual or a corporation. Yeah, just some other things to keep in mind when you're starting your own business. Aside from the core accounting, tax, and legal matters that we've talked about, is just keeping in mind that you're probably going to need to set up a bank account. So you're going to need to approach your bank and have your documents and affairs in order so that you can establish that bank account. And usually banks like startup companies, and they will have a lot of favorable programs to either set them up with credit cards or lines of credits, or a lot more favorable terms just to get you in the door and attract your business. And banks tend to be a lot more friendly when you don't need them. And that's usually at the beginning, because you don't have any debt when you're starting your business. So banks will be a lot more happy to provide credit to you when you don't necessarily need it. And I would always suggest, well, take it. And if you're disciplined enough not to use it or only use it when you need it, take it, bank it, kind of keep it there, set up for the rainy day when you have to tap into it. That's one thing. The other thing is registering for things like GST, payroll if you're going to have employees, or pay yourself or family members. That has to be done, whether you're a proprietor or a corporation. GST and payroll will affect you if you have employees. or you have GSTable services and uh, and banking. So those are the main things that I would keep in mind, in addition to the income taxes and legal uh, registrations and affairs that you need to address in the beginning.